If you're studying for the SIE exam, you already know that customer accounts are a huge deal. So today, we're going to break it all down, from the simplest individual accounts to the more complicated stuff like trusts, so you can walk into that test feeling totally prepared. Let's get right into it.
Yeah, I know, it's a bit of a morbid question to start with, but it gets right to the heart of why this stuff is so important, not just for the exam, but for, real life. And the answer to that question? It all comes down to one thing: how your account is registered.
So here's our game plan. We'll start with the basics, the blueprint of ownership. Then we'll get into accounts for one person versus a few people. After that, we'll look at accounts built for specific goals like retirement. We'll also cover who really has control, and then we'll wrap it all up with the absolute must-know takeaways for the exam.
I want you to think of account registration as the blueprint for your entire investment account. Seriously, it lays out all the rules of the road, who's in charge, who gets the money, and what happens when life, happens. So, at its most basic level, this is what we're talking about. It's just the formal relationship that lets you get in the game and participate in the market. But the real details, the ones that really matter, are all in how that relationship is set up.
And this is exactly why that setup is so critical. Registration isn't just some boring paperwork. It decides three absolutely crucial things: who has the power to make trades, who gets the mail and the updates, and, coming back to our big opening question, who actually gets the assets when you're gone.
Okay, so let's see how this all plays out in the real world. We'll start with the most common accounts you're going to see, starting with the super simple stuff, and then we'll work our way up.
So the individual account is about as straightforward as it gets. One person owns it, that one person controls it, and that one person is responsible for all the taxes. Simple enough, right? And when the owner passes away, everything in the account just becomes part of their estate, ready to be passed on according to their will.
So what happens when you add another person to the mix? Well, you get a joint account. You see this all the time with married couples, business partners, you name it. But adding more people introduces a really big choice, especially when it comes to what happens when one of the owners dies.
Now, this right here is a super important distinction for the SIE exam. You've got two main types. With joint tenants with rights of survivorship, or JTWROS, the surviving owner automatically gets everything. The assets completely bypass the will and that whole probate court mess. But with tenants in common, or TIC, the deceased person's piece of the account goes to their estate, to be handled by their will. You have got to know that difference.
Okay, so beyond just who owns the account, some accounts are designed for a very specific purpose, like saving for retirement or setting up a child's future. And as you can probably guess, these come with their own special sets of rules.
IRAs, individual retirement arrangements. This is a massive topic. The two words to remember are tax benefits and rules. With a traditional IRA, you might get a tax break now, but you pay taxes when you pull the money out in retirement. With a Roth IRA, it's the total opposite. You use after-tax money now, so your qualified withdrawals in retirement are 100% tax-free. The exam will definitely quiz you on that.
All right, let's talk about accounts for kids. You'll hear the terms UGMA or UTMA. These custodial accounts are just a way for an adult to give a financial gift to a minor. It's all about two key players: the adult who manages it, called the custodian, and the minor who actually owns it.
So here's the crucial part to understand. The custodian, the adult, they're like a financial guardian. They make all the investment decisions, they handle the paperwork, but they're doing it all for the minor. Why? Because the minor is the true legal owner of every single penny in that account. Look, if you only remember one thing about custodial accounts for the exam, make it this: the money is an irrevocable gift. That means the custodian can't take it back, they can't change who it's for, and they definitely can't use it for themselves. It belongs to the minor. Period. End of story.
All right, in our last section before we hit the review, we're going to look at situations where control over the money gets a little more complex, often because a third party is making the big decisions.
So, a trust is a formal legal entity. Think of it like this. You have the grantor, that's the person who puts the assets in. You have the trustee, who manages those assets based on the rules, and you have the beneficiary, the person who ultimately gets the assets. It's a really powerful tool for estate planning.
This seems like a pretty obvious question, right? The answer is, you are. But what if you wanted to give that power to someone else, like your broker? Well, that brings us to a super important concept that you will absolutely see on the SIE exam.
And here it is, plain and simple. In a normal, non-discretionary account,
You, the customer, have to say yes or no to every single trade. But in a discretionary account, you give your broker written permission to make trades without calling you first. The key word there, and I guarantee this will be on the test, is written. Verbal permission, it's never, ever enough.
All right, we have covered a ton of ground. So let's lock in the most important points for the exam with a quick, rapid-fire review.
First thing, always remember that the account title is everything. It tells you who's in charge and who gets the money when the owner dies. If you get that, you've got the foundation down.
Second, if a broker is going to trade for you without asking permission every single time, they need your signed, written authorization. No exceptions, no shortcuts.
And finally, the golden rule of custodial accounts. It is the kid's money. The custodian is just the manager. They are not the owner. That gift is permanent and it belongs to the minor.
So, we've just covered the entire blueprint of financial ownership. And understanding all this stuff isn't just about passing an exam. It's about making smart decisions for your own life. So now that you know the rules of the road, what's your next financial move? Thanks for listening.